Everyone says semiconductors are the future. Here's what they don't say. You can be early to the future and still lose money. That's what's about to happen to a lot of people in semiconductor stocks. They think the AI boom will carry everything. They think 6 years of growth means the seventh is automatic. They think a good business always makes a good investment. That's how they get trapped, because when margins slip and tailwinds slow down, you don't find out from the chart, you find out from the cash. There's a hole in how most people think about Applied Materials, and if you don't see it, you're betting blind. Everyone watches the top line like it matters most, but the pros, they watch the margins, because revenue feeds egos. Margins tell you if the business is working. Here's what just happened. Applied Materials, ticker AMAT, their revenue was down 3% year over year. Not great, but not fatal either. That's not what bothered me. Margins dropped. Again. Gross margins came in at 48.1%. That's lower than last quarter, lower than the one before that too. That's the trend. And when a company starts slipping on margins, it's usually one of two things: cost pressure or pricing weakness. Applied Materials has both. They're investing into new tools. Good, but those new tools aren't converting fast enough into high margin volume. At the same time, pricing power is getting hit by pushback from fabs, especially outside the US. Here's the punchline. Growth isn't the enemy. Margin compression is. And right now, Applied Materials is holding up on paper, but bleeding on the edges. If you're holding this stock, stop asking, did revenue grow? Ask, are they still elite at turning revenue into real profit? Because that's where the cracks start to show, and they're already showing. China exposure is shrinking, but the damage is already done. Everyone's cheering that Applied Materials is diversifying away from China. That's spin. The reality, they're losing a massive customer, and there's no replacement lined up. China made up 45% of Applied Materials revenue earlier this year. In the last quarter, it dropped to 29%. That's not strategy, that's survival. The US export controls aren't a speed bump, they're a brick wall. This isn't a theoretical risk, it's real. That drop in revenue isn't just about lower demand, it's about not being allowed to sell the best tools to one of the biggest markets in the world. Here's what that means for the business. They can't push cutting-edge tools into China. China can't become a growth engine anymore. That capacity doesn't magically reappear in Europe or the US. And if you think this is a short-term problem, think again. The rules aren't loosening, they're tightening. Every time you hear someone say we're moving beyond China, translate that to, we're trying to replace billions in lost revenue and hoping no one notices. The damage is done. The real question now is how much more it spreads. AI tailwinds, they're real, but they are already priced in. This is where most investors fool themselves. They see AI and assume growth is guaranteed, but in the last quarter, AI didn't save the numbers. It padded the narrative. Yes, Applied Materials is building tools for advanced packaging, GAA transistors, and high-performance compute. Yes, those tools will be critical over the next 5 years, but no, they're not moving the needle yet. Not in volume, not in margin, not in profit. They launched the Extra Etch system and the Mira Mesa CMP platform. They're scaling up the Epic Center for long-term partnerships. That's a good strategy, but strategy doesn't hit the profit and loss until fabs are ordering in size, and that wave hasn't started. Meanwhile, the stock is up 36% this year. That means the AI optimism is already in the price. The expectations are loaded, and if execution lags, the snapback will be brutal. Hope isn't a tailwind, revenue is. Right now, investors are pricing in future demand that doesn't exist yet. They're buying a headline and ignoring the delay between invention and profit. You don't get paid for what's coming. You get paid when it hits the numbers, and Applied Materials hasn't hit them yet. Applied Materials is definitely pushing forward, but the pack is catching up fast. Applied Materials is still a leader, no question. They've got real tech, real partnerships, and they're shipping tools that competitors haven't figured out yet. But the lead they built over the last decade, it's under attack. In the last quarter, they rolled out a hybrid bonding platform and expanded their Epic Center. That gives them direct collaboration with TSMC, Samsung, and Intel. It's a strategic advantage. Early access means faster iteration. Faster iteration means dominance, at least for now. But they're not running alone. Lam Research is gaining ground. Tokyo Electron is scaling hard. ASML still controls lithography, and every single one of them is chasing the same AI build-out. There's no room to coast. Here's where people get it wrong. They see leadership and think it means security. It doesn't. It means pressure. You don't stay on top by being good. You stay on top by staying ahead. And Applied Materials is running out of room to coast. If the orders slow and the competitors close the gap, that lead disappears. Not overnight, but fast enough to hurt. Innovation keeps you in the game. Execution keeps you ahead. Right now, Applied Materials is doing both, but so is everyone else that matters. And the shrinking margins, that's your clue the lead is already slipping. The financials are strong, but show signs of wear. At first glance, the numbers still look solid. Net profit margin is 23.9%. Cash return on invested capital, 22.5%. Free cash flow margin, over 20%. These aren't bad numbers. They're elite. But investors mess up when they only look at where the business is, not where it's headed. In the last quarter, revenue fell 3%. Operating margins narrowed. Gross margin dropped again to 48.1%. That's the third quarter in a row it's declined. This isn't a one-off, it's a trend. And when you start bleeding margin during a capital expansion cycle, it usually means your pricing power is under pressure. They're still profitable, but the cost of staying profitable is rising, and that's the red flag most people skip over. So if you're a long-term investor, this is what you pay attention to. Are margins stable or compressing? Is free cash flow scaling with revenue? Are they doing more with less or spending more to stand still? Applied Materials isn't falling apart, but the wear is showing. And once financial momentum breaks, it's hard to get back without a product catalyst or a new demand wave. Strong companies don't just post strong numbers, they protect them. Applied Materials needs to prove it can. So is this a good long-term investment? Let's start with the bull case, and it's a real one. Applied Materials is locked into every major node transition in semiconductors. Foundries can't scale without them. Their partnerships run deep. TSMC, Samsung, Intel. Applied Materials isn't just a supplier. They're in the room where decisions get made. And in a world chasing smaller transistors, better packaging, and AI-optimized chip designs, Applied Materials owns tools no one else can match. That's the moat, and it's not theoretical. That's why they've been profitable through the cycle. That's why their cash return on invested capital still sits above 22%, and that's why the stock's up 36% this year. But the bear case matters too, and ignoring it is how people get hurt. Margins are compressing, China revenue is collapsing, export restrictions are capping growth, and competitors are getting better by the quarter. Lam Research and Tokyo Electron don't have to catch up everywhere. They just have to eat into the right product lines. That's enough to break the growth narrative. The real risk? That Applied Materials is entering a transition zone, one where costs stay high, growth slows, and they have to defend their lead while under pressure. If you're betting on Applied Materials long term, here's what it comes down to. Can they maintain pricing power? Can they stay in front of the node curve? And can they avoid becoming commoditized while everyone else catches up? Because a great business doesn't guarantee a great investment. Execution does. What I'm doing right now, is this a buying or selling window? This isn't a long-term buy for me. Margins are slipping, competitive pressure is rising, and the China revenue cliff is still being priced in. That breaks my core criteria for long-term conviction. But I'm watching it for a swing trade. If I see a clean setup with tight risk control, I'll take it, because good businesses can still be tradable, even when they're not compounding machines. Everyone has their own criteria. If you love the story and believe in the roadmap, go for it. Just know exactly what you're betting on and how much risk you're really holding. Now let me ask you something. Who else is showing you how to break down real earnings, challenge fake narratives, and make money while everyone else chases headlines? Who else gives you the bull and the bear case, ties it to actual execution, and helps you make clear, disciplined decisions with no hype? Nobody. That's why my accounts are now up over $2.4 million this year with a 68.79% year-to-date return, and I'm not the only one. Sam cleared 266% on Apple contracts. Steven locked in a 97% gain on Palantir and captured a 100% premium on a 7-hour trade. Air Tractor just ran up 382% on IAG. This isn't theory, this is execution. Inside my Patreon, you get real-time trade alerts, every entry, every exit, and why. Daily breakdowns, only what matters, zero fluff, and my exact momentum system for scaling into trades like these, and access to the most committed, no BS investing community I've ever seen. It's $30 a month. Instead of blowing that on bullshit, put $30 into something that actually makes you better. If it doesn't 3x your investment, cancel anytime. no excuses, no drama. Most of my members stick around for years. Why? Because this system works and it keeps making them money. The only real question is, are you ready to stop watching other people win and finally become one of the results I feature? I'd love for that to be you, because the choice is simple. You can scroll or you can scale, but either way, you won't say you didn't have the chance.